Good morning, everybody. Welcome. We are excited to have a conversation today about banks and Iowa banking. And when we've spoken to all of you about this individually, I've always said, Iowa banking's supposed to be boring. But as of late, it's been anything but. We've had three big banks fail and subsequently either be taken over or purchased by another larger bank. And so, whenever these kind of changes are happening, we get lots of questions: Is my money safe? Should I be doing anything with my money inside of banks? And for many of you, you bank here in Iowa, and so I'm really pleased today to have a special guest with us, Becky Pratt. So I'll bring Becky in here. Becky, good morning.
Good morning, Matt.
So I've known Becky for a long time. We go way back to Wells Fargo days, I think, don't we?
Yes, all the way back to the early 2000s, I think we met when I started at Wells Fargo, and you were doing lunch and learns to orient new employees about the options for investing,
Yep. Yep.
401ks,
401ks and all that
rolling
stuff.
over.
Yeah. Those
Yep.
those were the days. So it's we've been friends and acquaintances ever since. And Becky's got an impressive history as a FDIC former FDIC examiner. I'm going to share part of her bio with you. She's a board member, entrepreneur, board advisor, and chief risk officer who drives positive change in small to mid-sized banks, mortgage lenders, and related regulated service providers. She's a qualified risk director, former FDIC bank examiner, certified regulatory compliance manager, and skilled enterprise risk management professional. So lots of experience in the banking industry and the what I'll call the behind the scenes banking industry, things that areas of the banks that we don't probably even know is going on in a lot of cases, but keeps all of us safe in particular the Iowa banking industry. So, what made you interested in doing this, Becky? What's kind of been the impetus to your career to follow this career path that you have?
So I think it was the the base that I have was in the examination, bank exam, and then I went into CPA firms and bank audit. And I made that switch because as an examiner, I couldn't really help. Uh, and as a bank auditor, I could certainly help more. But I knew eventually when I did the audit work that I wanted to go into consulting and be able to help even further. So the audit piece, I think, has been really the biggest experience, both internal and external audit at banks, specifically Iowa banks, mostly Iowa banks, but the large bank experience at Wells Fargo helped a ton as well. And that is where, like you said, I get to see everything, all sides of the bank, all areas of the bank, and kind of dig in and learn what's going on and know how it connects together.
Mm. And so when you see something happen like of recent, we all went through '08. We kind of know what happened there to an extent, depending on if you've seen The Big Short or not, or whatever your own personal experience was. But for you and I, it was front and center, and obviously a huge concern and part of our business and a big impact on our client lives. Well, then all of a sudden we get news over a weekend a few weeks ago that Silicon Valley Bank is gone down and basically all a run on their deposits, and that then filtered into a couple other banks. And then just this weekend, J.P. Morgan purchased First Republic, I believe.
Yep.
So we're seeing some fractures in the banking industry. How would you contrast the Silicon Valley Bank failure, the beginning of this, to maybe the '08 crisis? And then let's talk about Silicon Valley Bank compared to Iowa banks.
Okay. So it was a lot different from the 2008 through kind of 2010, 13 timeframe. That timeframe was really around credit and credit quality, and it was industry wide credit quality. So it was around the mortgages in portfolios, and eventually the commercial real estate and bank portfolios, and it all happened at once as far as an ability to repay loans, which is on the asset side of the balance sheet. What happened here is on the liability side of bank's balance sheet, on the deposits side. And it started with the bank run that happened on Silicon Valley. It may have even started before that, when the Silvergate Bank, which was a crypto concentrated bank, decided to stop operations. So the difference is that a run on deposits in a bank will cause a lack of cash. And that's exactly what happened in Silicon Valley Bank. And the reason that happened was due to their concentration in one certain area, one certain business. For Silicon Valley Bank, it happened to be tech and startups. For Silvergate, it was crypto. For Signature Bank, it was crypto as well. And then First Republic was concentrated in really tech and high wealth clients.
Okay.
So then everybody wants their money all at once. Something happens in that industry. They all want their money all at once, causing the bank run on the bank, which is really the worst thing that we ever want to see for an individual institution.
Yeah, so it seemed that it got out on Twitter. One of their large depositors caused, there's a reason for concern here. They all ran, and then what seemed to happen is they had to sell investments that they didn't want to sell. They had to sell them before they expected to have to sell them, and there was a
Right.
mismatch in the price and what they were actually having to provide, and that difference caused some heartburn. Is that close?
Right. Right. Close. So first, the um, funds started to run off in Silicon Valley Bank because of the need for cash in tech. And as they ran off, the deposits started going out and going out.
Mhm.
The Silicon Valley Bank needed more cash to continue to fund those outflows of deposits. To do that, they had to sell assets. The assets that they sold were long term treasury bonds, which lose value when interest rates rise. And so that was two. Mistake number one was the concentration in one industry. Mistake number two was taking all those deposits that came on very quickly over the course of the pandemic in long term. They're short term deposits. They're deposits that can leave the bank immediately if the customer wants it. And they took those deposits and invested them in investments that don't mature for years and years, long term treasury bonds. So that's the mismatch piece.
Mhm.
So that's mistake number two.
I
Um,
see.
and mistake number three, or I don't know, event number three really was the viral nature that you mentioned. It happened so quickly over Twitter, on cell phones, on apps on cell phones. Within seconds, people could take their entire balances out, which were mostly uninsured. Another point that uh, was not helpful on
No.
on either party side.
Yeah. Well, in the old days, we'll call it the old days, but in prior times, you had to go to the bank to get your money out. Now, with
Right.
phones, you push a button, and with social media, you find out immediately that there might be a problem, or even just a rumor of a problem. It doesn't always mean there is one, but so that definitely came to roost. So, how would you characterize either the deposits or just the structure of a Silicon Valley bank versus, and I'm not asking to say all Iowa banks, but most Iowa banks?
Really, yeah, really. In general, most community banks as well. So banks under 10 billion in asset size, and Iowa banks and community banks. And so when we talk about banks, we talk about asset size instead of revenue. Silicon Valley Bank was $209 billion in total assets, I believe, at the time of its failure. Most of the banks in Iowa, we have about 250 banks total in Iowa, and of them, about 150 of them are under 300 million in total assets, and then around just under 100 are over 300 million in total assets, and just a few over a billion, about five over 1 billion, five or six. So much smaller banks, and also much more diversified portfolios, both on the asset side and on the deposit side. So a mix of ag loans. The ag industry helps Iowa banks a ton because of the nature of the repayment of those loans. It happens over time. The money goes out and comes back in over time, not all at once. There's commercial real estate and mortgage lending as well. So much more balanced asset portfolios, and then very fewer uninsured deposits. The uninsured deposits are very, very low in Iowa banks and in community banks in general compared to Silicon Valley Bank.
I see. Okay. So the likelihood of a mismatch, like you mentioned for Silicon Valley, you feel is less likely in Iowa banks, generally
Yes.
speaking? Okay.
Right. So the fundamentals in banking are around making sure that you match your funds. So the fact that Silicon Valley Bank did not spend the time to match their fund inflows and outflows shows us a real problem in management and risk management. Here, it's in my clients and every bank I've been in the last 30 years has had, well, put it this way, that's the worst mismatch I've ever seen, the Silicon Valley one in a bank in 30 years. It was just beyond my comprehension.
Hmm.
Normally, there are specific steps that banks will go through and say, okay, these funds are coming in. Now we have to find a place to put them so that we can access them when we anticipate they need to go out.
So in after the '08 mess, the of course Congress and everybody piles on and says we're going to re-regulate, and we had Dodd-Frank come out as a result of all of that. I remember, the rating agencies for bonds back in '07, '08 were kind of a joke. They had all these junk bonds that they had rated AAA, and then when they came
Right.
to roost were worth nothing. And so it begs the question, because some smaller banks, as I understand it, were able to, like Silicon Valley, lobbied for less regulation in certain areas. And so it almost seems like they grew so fast they got ahead of the regulators. Do you think
Mhm.
that's fair? Do you think regulators are doing their job? Maybe some thoughts there.
Yeah. So I know we saw the report come out from the Federal Reserve and they took some responsibility on Silicon Valley. But having been a regulator, I know they were watching. But your point about the fast growth is really what it's all about. That kind of quick growth, they grew by two times their size, I think, within a year.
Mm.
And that was that influx of all those deposits that happened during the pandemic, where there was this perceived flight to safety, where depositors threw their money into banks feeling that it would be safe, but didn't think about the tech industry in particular, didn't think about, oh, only $250,000 of my money per account, per ownership is covered in FDIC insurance. So the whole that just doesn't happen here in Iowa. We don't see the uninsured deposits like that, and we don't see the specific concentrated uh, percentage of the portfolio concentrated in one industry like that.
So I think people would be concerned, and you commented on this already, that ag would be an industry that we're too concentrated in it here in Iowa. In the event commodity prices tanked, we had a huge glow. I mean,
Mhm.
I've been reading lately about all this deglobalization. For after early 2000s, it was all globalization. We're gonna add supply chains and moving Maytag to Mexico and all of that. Well, now that's changing. A lot of countries are getting more domestically centric. And so, do you feel like within Iowa, the ag thing, if that was to go off the rails, we'd have big problems with Iowa banks?
I think if there are problems in ag, it does transfer into Iowa banks, but not to the extent that we've been seeing in these three banks that we're talking about, because there are other conditions, other types of assets and liabilities that the banks have that will protect them. So, for instance, on the ag side, if the bank gets into some credit quality issues where farmers can't repay their loans on time. They also have small business loans, and maybe those small businesses are doing well and they're able to pay their loans. And then on the deposit side, same thing. They might have deposits from their ag customers, but they also have deposits from their consumer customers, and they have a high percentage of consumer customers compared to those much larger banks and the small businesses. And there's just that mix of different types of accounts that balance all of that out. And one last thing on the ag thing or any other type of industry, if on the credit side they get into trouble, you have time to work that out. On a deposit side, when you have a run, there's no time. Does that make sense?
Sure. Yeah. Like we said, things happen so quickly, and yeah,
Right.
I would assume changes in ag take some time. So
Yeah,
You shared a slide with me on this Iowa core deposits ratio,
right.
and so let me get in here real quick.
So yeah, where I'm going with this is just to demonstrate the difference between Iowa banks and even FDIC community banks. So all FDIC insured banks under 10 billion in total assets. That's the two different lines here. Um, there we go. And so the FDIC banks are the more orange colored line, and the blue line is the Iowa state chartered banks. So what this shows is core deposits, or the deposits that are considered sticky at a bank that wouldn't run off quickly, the as a percentage of total assets is what this slide shows. So for the Iowa banks, 79% of their core deposit, well, core deposits are 79% of their total assets, and
Okay.
80% for FDIC community banks. Comparing that to Silicon Valley Bank, they had 75% of their total assets in uninsured deposits, in what we would call non-core deposits. So 80% of their portfolio, 75%, so nearly the same amount of their portfolio, was subject to runoff, as banks have, subject to staying in the bank. And
So
that
essentially
probably
that
portrays the, go ahead.
so essentially that chart would flip because we had
Right,
79% in Iowa core, Silicon Valley
right,
79% core in non-core.
right. 75% in non-core at Silicon Valley, which is similar to core in Iowa. So much safer in Iowa, much safer in Iowa compared to what that number was at Silicon Valley Bank. I don't know I've ever seen uninsured deposits as a percentage of total assets that high
Hmm.
before either.
So as in all things, Iowa remains better than California. Is that?
Yeah, yeah,
I mean, in
yeah,
banking we kick their butt, in quality of life, not weather, not weather, but uh,
not weather.
quality of people, and obviously our banks are also something to be proud of. It sounds like.
Yeah, and they're more conservative generally in nature. They're more conservative than those big coastal banks. Um, and they're better. I didn't look at other states, but I did look at Iowa as far as their ratings from their regulators. And in the state of Iowa, almost 95% of the institutions, state chartered institutions in Iowa, are rated either a one or a two, the best two ratings you could get from your regulators. That's extremely good. Now that is a lagging indicator per your question about ag. If something were to come down the path as a result of the economy to bite into the earnings or the capital of the banks, that could go down a little, but you don't see that happening drastically or quickly. And there are processes and procedures in place for banks to address any types of credit quality issues. And there have been a lot of conversations with bank customers about deposits and how to keep them insured and how to structure them um, to the benefit of the customer.
Hmm. And so, one last topic here. Charlie Munger over the weekend, who works with Warren Buffett, spoke about fractures in commercial real estate. And so,
Mhm.
office space, we're seeing Wells Fargo here in Des Moines move all of their employees out of downtown, out to their west campus. I would expect that a lot of these downtown office complexes have to repurpose, similar to some of the malls that have had to go through that. Do you see anything in your studies or your discussions with Iowa banks that they have undue real estate exposure that might come to roost?
So again, the banks in Iowa tend not to hold concentrations like we saw at Silicon Valley and some of these other large banks. So, so if that goes into distress, and we do see some signs of stress in commercial real estate starting to happen, um, I think there could be an impact, but it wouldn't be a, a seismic jolt. Um, and I don't see in the Midwest the problems that we're seeing in commercial real estate in places like San Francisco
Mhm.
or New York City. They're yeah, we're in Des Moines. That will hurt, I think, a little bit, but it's an opportunity also to take that space and maybe do something else with it and finance it differently and still make it cash flow.
Yeah. And even when in '08, when we went through the real estate crisis, Des Moines slowed down, or, Iowa
Mhm.
slowed down, and prices did go down in some areas, but nowhere near the overbuilt Floridas and Scottsdales and all that, if I remember. So hopefully we've done the same. I think the office thing is caught because we're so insurance centric, particularly here in Des Moines.
Mhm.
The whole flight to working from home thing has caught a lot of companies by surprise. But then we
Mhm.
see, like, in Mid American Energy buying Meredith's old home headquarters, and some of the old Nationwide buildings being purchased by the city of Des Moines, and so
Mhm.
stuff tends to just move around, doesn't it?
Yeah, it does. And I think we've also had quite the influx of population in Des Moines over the years too. It's become a popular place. So I think there'll be some innovative solutions to some of the problems that are coming up.
Great. Well, Becky, I can't thank you enough for your time and your expertise here. I know this is going to be valuable information for folks as they try to wade through. It's one of those times when you see bank failures, it can really make you panic. You can feel like, wow, if I don't have my bank deposits, I'm really at risk. And so having some comfort that Iowa banks are relatively safe, that we've got FDIC stepping in to assist when needed. On these three bank failures, you would expect they would be able to hold us up as well. But your sharing the core deposit story and all that has just been really, really valuable. So thank you so much.
You're welcome, Matt.
All right, thanks everybody. We'll see
I
you.
appreciate it.
Yep, thanks for joining us today, and we will be back with you here real soon. Thank you.